Hello everyone. On this channel you can watch weekly or long-term financial analysis and tutorials in the near future. We help every trader or prospective trader to trade with more financial knowledge, better understanding of the context of financial markets and more profit making in the future. The global economy, financial markets are fully illustrated in our videos, as America, China, Russia, India, Japan, Australia, Europe are the primary. What is swing trading? It's the swing in the asset's price, from one value to another, that gives the trading method its name. It is based on the assumption that market prices rarely move in a straight line, and that traders can find opportunity in the minor oscillations. Swing trading works by identifying profitable times to enter trades based on two different types of swing, A swing lows and A swing highs. Swing trading refers to the practice of trying to profit from market swings of a minimum of one day and as long as several weeks. Positions are typically held for 1 to 6 days, although some may last as long as a few weeks if the trade remains profitable. A swing trading strategy involves traders buying a security when they suspect that the market will rise, or selling an asset when they suspect that the price will fall. Swing traders can take advantage of the market's fluctuations as the price swings back and forth, from an overbought to oversold state. Traders who swing trade stocks find trading opportunities using a variety of technical indicators to identify patterns, trend direction and potential short-term changes in trend. The trading rules can be used to create a trading algorithm or trading system using technical analysis or fundamental analysis to give buy and sell signals. Swing trading involves identifying profitable times to enter trades based on two different types of swing, A swing lows and A swing highs. A swing low is a term used to refer to a major price low, while a swing high is a term used to highlight a major price high. A swing trader is concerned with working to capture the price movements between these major lows and highs. It is impossible to consistently pinpoint the exact high and low of every swing move, but the idea is to capture as much of the price movement as possible. Swing traders will focus on taking smaller, but more frequent gains, and cutting losses as quickly as possible. Momentum signals, for example, 52-week high, low, have been shown to be used by financial analysts in their buy and sell recommendations that can be applied in swing trading. The main difference between swing trading and position trading is the time that the financial asset is held for, whereas swing trading aims to capture the upswings and downswings in price for a short period of time, often for a number of days or weeks. Position trading involves a longer time frame. Position traders tend to buy assets and hold them for several months or even years, depending on the trend direction. Summary: can you make a living swing trading? Swing trading is an alternative strategy for those who favor short-term trading, but can't dedicate hours to trading every day. While it requires a comprehensive understanding of technical analysis, it can result in more efficient returns relative to day trading. As with any form of trading, there will be risks involved. What are market trends? When the trading market responds to the ups and downs of the prices associated with investments and securities, the terminology that applies to a market trend is bull or bear. A trend is the overall direction of a market or an asset's price. In technical analysis, trends are identified by trend lines or price action that highlight when the price is making higher swing highs and higher swing lows for an uptrend, or lower swing lows and lower swing highs for a downtrend. Whether those peaks and troughs are moving up, down, or sideways tell us the trend of the market. The old adage "the trend is your friend" means you should trade in the same direction as the trend. The strong trend in the market is that it always breaks through the next level of support or resistance. The four stages of a market cycle on a long-term chart are the phases of accumulation, uptrend, distribution, and downtrend. All markets tend to eventually go through all four of these phases as a full cycle plays out from the lows to the highs and back lower again. It is important to know what phase of the market you are trading is in to understand the best strategy to use. Basic trading strategies: buy support and short resistance in a range-bound market during accumulation and distribution phases. Buy pullbacks and breakouts in an uptrend, short rallies and breakdowns in a downtrend. What is trend trading? Trend trading is a strategy that involves using technical indicators to identify the direction of market momentum. It is based on the idea that markets have an element of predictability, so by analyzing historical trends and price movements, a trader will be able to forecast what could happen in the future. What is an uptrend? An uptrend describes the price movement of a financial asset when the overall direction is upward. In an uptrend, each successive peak and trough is higher than the ones found earlier in the trend. An uptrend is made up of ascending peaks and troughs, higher highs and higher lows. What is the uptrend line? An uptrend line is a straight line drawn upward to the right that connects two or more low points. The second low must be higher than the first for the line to have an upward incline. What is a downtrend? A downtrend is made up of descending peaks and troughs, lower highs and lower lows. What is the downtrend line? A downtrend line is a straight line drawn downward to the right that connects two or more high points. The second high must be lower than the first for the line to have a downward incline. Trend trading is the most profitable trading technique. What is a sideways trend? A sideways trend, consolidation, is when prices move sideways in a horizontal range. A support level is a level where the price stands to find support. As it falls, price is more likely to bounce. Support is the level at which demand is strong enough to stop the stock from falling any further. A resistance level: it is where the price stands to find resistance as it rises. Resistance is the level at which supply is strong enough to stop the stock from moving higher. The more often a support, resistance level is tested, touched and bounced off by price, the more significance is given to that strong specific price level. The opening price, monthly, weekly or daily opening price, $0.08 monthly, weekly and daily minimum and maximum levels, $0.08 monthly, weekly and daily opening and closing zones, $0.08 monthly, weekly and daily ATR resistance or support, $0.08. The gap support and resistance. A support level is a level where the price stands to find support. As it falls, price is more likely to bounce. Accumulation or distribution uses volume to confirm price trends or warn of weak movements that could result in a price reversal. Large professional and other institutions, hedge fund interests prepare for their next bull or bear move. They accumulate or distribute shares within the trading ranges. The method based on the law of supply and demand, that charts price and volume and their relationship over time. Every minute of the day on the market it is demonstrating whether supply or demand is greater. Small 1 min, 1 hour, daily and weekly waves gradually develop into larger waves, which eventually build into a big bear or big bull market trends. Big institutional players and smart money traders take significantly large positions in these types of range price zones. There are two ways to win money on the stock market: exchange rate gains, dividend yield, dividend/price. 3 popular swing trading strategies: trend trading, breakout trading, pullback trading. Trend trading. A trend trading strategy relies on using technical indicators to identify the direction of market momentum. Swing trading strategies will look to capture a portion of this trend, taking advantage of the swing high or low trend, the general direction of price movements in a given period. Trends are shaped by 4 important and interrelated factors: governments, international financial transactions, speculation, expectations, and demand, supply. When analyzing trends, past price movements are compared with the current price. The trend is your friend. What is a breakout trading? A breakout is a sudden, potent directional move. Is a financial product price moving outside a key defined support or resistance level with increased volume. Identify points at which the market is about to break out from the range in which it has been trading. What is a false breakout? A false breakout is when price temporarily moves above or below a key support or resistance level, but then later retreats back to the same range zones as it started. Swing traders will look to identify points at which the market is about to break out from the range in which it has been trading. Typically when a support or resistance line is broken, a breakout trader can use price, a technical indicator, or fundamentals to prompt them into a breakout trade. This strategy looks for levels or areas that a security has been unable to move beyond, and waits for it to move beyond those levels, as it could keep moving in that direction. When a price moves beyond one of these levels, it is called a breakout. Breakout trading requires the trader to know how strong or weak the market momentum is, which is usually calculated using the volume of trades that are taking place. This is why volume-weighted moving averages are a popular technical analysis tool among swing traders. A breakout trader looks for patterns. For example, instances where the price of a security has been resistant to moving above or below a specific price level or price area. Then, the trader attempts to profit by entering a trade in the breakout direction, assuming that the price will continue to move in that direction. A breakout trader looks for price, a technical indicator, or a data point to move beyond a support or resistance level. Managing risk on a breakout is important, because not all breakouts succeed. In fact, many will fail. Many will fail. Many will fail. Many will fail. Charts patterns. Chart patterns are a common type of breakout. Chart patterns include triangles, wedges, channels, rectangles, head and shoulders, cup and handle, and expanding ranges, Bollinger Bands, trendline, technical indicator, moving averages, relative strength index, fundamental data, earnings, estimates, future expectations, company profitability. Volume trading. The volume of trade is used as a measure of liquidity and activity. Trading volume, or volume in trading, is the number of completed trades in a single security or across a whole market in a given time period. Volume can indicate market strength, as rising markets on increasing volume are typically viewed as strong and healthy. Technical analysts use trading volume data to assess the strength of a price movement and whether it'll stay at its new level for very long. When the price of a stock goes up, technical analysts check if volume rose as well. If it did, then these analysts consider the price movement more significant and more likely to stick. However, high trading volume can also indicate a price reversal. On-balance volume, OBV, Chaikin money flow and the Klinger oscillator are examples of charting tools that are based. What is a pullback? A pullback is a pause, a moderate drop in a stock or commodity's pricing chart from recent peaks that occur within a continuing uptrend. The term pullback is usually applied to pricing drops that are relatively short in duration, for example, a few consecutive sessions before the uptrend resumes. Traders can use limit orders or stop entry orders to take advantage of a pullback to get in on the primary uptrend. Pullbacks can provide an entry point for traders looking to enter a position when other technical indicators remain bullish. Most pullbacks involve a security's price moving down to an area of technical support, such as a Bollinger Bands, moving average, pivot point, or Fibonacci retracement level before resuming the uptrend. Pullback and breakout entry types: a sense price breakout, a sense range breakout, a sense pullback entry, contra trend entry, a sense false breakout. Pullback and breakout entry types: price breakout, range breakout, pullback entry, contra trend entry, false breakout. Indicators may provide a small lifeline into trading. Here are a few that can help swing traders make the right decision. In order to create a swing trading strategy, many traders will use price charts and technical indicators to identify potential swings in a market, and profitable entry and exit points. Popular swing trading indicators include moving averages, relative strength index, stochastic oscillator, Bollinger Bands, MACD indicator. Stock picking is the selection of equities based on a certain set of criteria with the hope of achieving a positive return. In today's global economy, analyzing vast amounts of information to arrive at an investment decision is very difficult. However, there are steps you can take to create a screening process to help sift through the large universe of ideas. The stock selection strategies discussed here are fundamental analysis, qualitative analysis, value investing, growth investing, GARP investing, income investing, can't slim, dogs of the Dow. Technical analysis. First, focus on fundamentals. Investors who use fundamental analysis generally use one of two fundamentals-oriented strategies. Growth investors focus on the future prospects of a particular company. Growth investors often look to 5 key factors when evaluating stocks: historical and future earnings growth, profit margins, returns on equity, ROE, and share price performance. Growth investors tend to favor smaller, younger companies poised to expand and increase profitability potential in the future. Growth investing is a stock buying strategy that looks for companies that are expected to grow at an above average rate compared to their industry or the broader market. Value investors focus on whether the current stock price makes sense given the health of a particular company. Value investors use financial analysis, don't follow the herd, and are long-term investors of quality companies. Value investors actively ferret out stocks they think the stock market is underestimating. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Stocks, like commodities, go through periods of higher and lower demand leading to price fluctuations, but that doesn't change what you're getting for your money. Value screening. You can use several metrics when searching for value stocks, though a simple approach would be to consider those with an above-average dividend yield, but not too high, low price-to-earnings ratio, a price that is less than the company's book value. Screen stocks using technical analysis. Price and market capitalization, sectors and industries, momentum breakouts, volume, liquidity, relative strength, volatility. Analyze potential investments with statistics. Market capitalization, categorized as micro, small, mid and large, capitalization, growth prospects, product life cycle. Dividend payments. Younger or high-growth companies usually reinvest free cash flows back into the company, while more mature companies may choose to use cash flow to pay above-average dividends. Screen focus on a company's financial position through financial ratios, liquidity ratios, debt ratios and profitability ratios, price to earnings, P/E, price to sales, P/S, price to book, P/B, and enterprise value to earnings before interest, taxes, depreciation and amortization, F/EBITDA. Fundamental analysis. His screening criteria focus should be the following: early stage industries, high revenue growth, smaller market capitalization, less than $1 billion. Ratios. Early-stage companies generally have unattractive ratios as they seek capital and spend more than they have to launch the business. Valuation. Generally only P/S is a possible measure as earnings are typically negative. Her screening criteria should focus on the following: mature industries, low or no growth companies, larger market capitalization. Ratios, strong liquidity and low debt ratios, high return ratios. Valuation, generally any ratio fits, but using P/E, P/B or Rev/EBITDA are common. This investor should seek low multiples and high dividend yields. Basic guide to trading: A trade entry point, limit orders, A stop loss, A price forecast, minimum exit level, A Fibonacci. Technical analysis. Trading plans. Risk management. An appropriate risk-reward ratio tends to be anything greater than 1 to 3. Money management. The 2% rule. Calculate 2% of your trading capital, your capital at risk. Diversification. Hedging. Types of trading and investment risk: systematic and unsystematic risk, business risk, volatility risk, liquidity risk, inflation risk, interest rate risk, credit risk, counterparty risk, currency risk, call risk, broker risk, news risk, political risk, country risk. Considerations. Price. One of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go next or what it should be, but as a general rule these should be disregarded. A trader need only be worried about what the market is doing, not what the market might do. The current price and only the price tells you what the market is doing. Money management. Another decisive factor of trend following is not the timing of the trade or the indicator, but rather the decision of how much to trade over the course of the trend. Risk control, cut losses is the rule. This means that during periods of higher market volatility, the trading size is reduced. During losing periods, positions are reduced and trade size is cut back. The main objective is to preserve capital until more positive price trends reappear. Rules: trend following should be systematic. Price and time are pivotal at all times. This technique is not based on an analysis of fundamental supply and demand factors. Diversification. Research published by hedge fund manager Andreas Kleno shows that cross-asset diversification is an essential part of professional trend following. Thank you for watching the video. I hope you enjoyed it and had a great time. Thank you if you hit like and share the video. Write your opinion in the comments and what would you like to see next in the videos. We have new, informative, educational and analytical videos coming. Be sure to subscribe. Have a nice day, everyone.